Imagine waking up tomorrow and suddenly the biggest question in crypto has an actual answer. Is this token a security or a commodity? Because right now, in the US, that single question can decide whether a project thrives, gets delisted, or gets sued into oblivion. And that uncertainty has been one of the main reasons institutions hesitate, builders move offshore, and everyday investors get wrecked by surprise enforcement actions. So today, we're breaking down the Clarity Act, what it is, what it changes, and why it could reshape the entire crypto industry. By the end, you'll understand what it means for exchanges, DeFi, and stablecoins, and the real-world impact for retail investors and the next bull cycle narrative. Let's get into it. For years, the US crypto market has operated in a fog. Companies ask for rules and get silence. Then they get enforcement. Projects list tokens. Then later those same tokens are treated like unregistered securities. Exchanges operate, then suddenly face lawsuits or pressure to delist. The result? Innovation gets pushed offshore. Consumers get fewer regulated choices. And the market becomes riskier, not safer, because uncertainty invites bad actors. This is what lawmakers mean when they criticize regulation by enforcement, and it's exactly the gap the Clarity Act is designed to fill: clear rules of the road. The Clarity Act, short for the Digital Asset Market Clarity Act, is a U.S. market structure bill. Market structure means it answers questions like what disclosures are required, who has oversight authority, what consumer protections apply. But the biggest headline is this: the Clarity Act tries to draw a bright line between, and that sounds simple, but it's massive, because the SEC and CFTC don't regulate the same way. The SEC is built around securities issuance, disclosures, broker-dealers, and investor protection. The CFTC historically regulates commodities and derivatives, futures markets, manipulation, fraud. Crypto has lived in the overlap and the confusion. The Clarity Act focuses on classifying crypto assets into defined buckets. The simplified version looks like this: assets treated like commodities, often called digital commodities, stablecoins, with their own framework and restrictions. Why does classification matter? Because classification decides where it can legally trade, which platforms can list it, what disclosures must exist, and what enforcement risks hit founders, exchanges, and even users. If the Clarity Act works the way supporters hope, the US stops guessing and starts operating with a clearer map. Here's where it gets real. A major theme of the Clarity Act is, if you're running a centralized platform that lists and trades certain digital commodities, you may need to register and follow tailored rules. Translation: more formal oversight, more compliance requirements, more standards around custody, risk controls, and disclosures. Supporters argue this is bullish long-term because it could reduce Wild West behavior, improve consumer protections, and give institutions a clearer compliance pathway to participate. Critics argue regulators will need serious resources and compliance could be expensive, potentially squeezing smaller exchanges. But either way, it's a shift from figure it out as you go to you have a defined lane. One of the most culturally important parts of the conversation around clarity is custody. Crypto's core promise is that individuals can custody their own assets without permission. The Clarity framework includes language that supports the ability of U.S. individuals to lawfully custody and transact with their own digital assets. That matters because it sets a tone. Regulate intermediaries, but don't criminalize the technology itself. This is one reason many in crypto see Clarity as a pro-innovation bill relative to approaches that overreach. Now let's talk DeFi. A major regulatory question is, do we regulate the software or the people running a business on top of it? The Clarity approach, at least in principle, is often described as aiming to protect software developers and peer-to-peer activity, while still requiring compliance from centralized intermediaries that interact with DeFi at scale. In plain English, writing and publishing code shouldn't automatically make you a regulated financial institution. But if you're acting like a broker, dealer, or exchange, especially with custody or control, you may be treated like one. This control versus code concept is a big deal. It's basically the attempt to avoid banning innovation while still targeting real risk centers. Here's where the politics get spicy. In the broader U.S. crypto policy landscape, stablecoins have become a battleground, especially around yield. Why? Because if stablecoins behave like interest-bearing cash, they can compete directly with bank deposits. Banks don't love that. So, one of the biggest friction points in recent policy debates is whether stablecoin issuers or platforms should be able to offer rewards simply for holding stablecoins. Supporters of limits say, this is basically interest, and it could drain bank deposits. Opponents say, this is competition, innovation, and consumer benefit. This fight matters because stablecoins are the plumbing of crypto. They power trading liquidity, cross-border payments, DeFi collateral, and tokenized financial rails. If stablecoin rules are strict, it can slow growth. If stablecoin rules are too loose, it can create systemic risk and political backlash. So, stablecoins, and especially yield, have become one of the most controversial parts of the overall regulatory puzzle connected to market structure. Let's stack the impacts. Legal certainty projects and platforms can plan, institutional compliance teams can approve participation, and markets can price risk better. Safer markets, potentially, tailored disclosures and registration frameworks can reduce wash trading, insider abuse, and outright fraud. U.S. competitiveness policy clarity can keep capital, builders, and infrastructure in the United States rather than pushing it overseas. A clearer path for tokenization. If the rules define what's a security versus commodity more cleanly, tokenized assets and on-chain finance can scale with less ambiguity. But you also need to understand the trade-offs. More regulation can mean more compliance costs. Agencies need funding and capacity. Bad definitions can unintentionally capture legitimate projects. So clarity isn't magic, it's a framework, and the details and implementation determine whether it helps or hurts. If you're a retail investor, the Clarity Act matters because it could influence which tokens stay listed on major platforms, how disclosures and risks are presented, whether exchanges operate under clear standards, and whether the U.S. market becomes a safer place to participate. But here's the most important takeaway. In crypto, narrative moves markets. If the market believes the U.S. is shifting from uncertainty and lawsuits to rules and access, that perception alone can improve sentiment, liquidity, and institutional engagement. Not financial advice, just reality. So, that's the Clarity Act, a major attempt to define the rules of the road for crypto, especially the line between the SEC and CFTC, while pushing the industry toward a more structured, regulated market. Now I want to hear from you. Do you think clarity will protect investors? Or will it restrict innovation? Drop your take in the comments, and if you want more breakdowns like this, macro, crypto, regulation, and the future of finance, make sure to like, subscribe, and turn on notifications for Express Econ Geo Finance Insights. See you in the next one.